People keep asking me the same question. Warren, the Strait of Hormuz closed. Oil spiked. Supply chains broke. And the stock market, within days, was back at all-time highs. The S&P 500's 10-day return was in the 99. 7th percentile of all 10-day returns in history. So is a bear market even possible anymore? Is the market just going to go up forever? I've been asked versions of this question through 12 different market cycles, through wars, panics, bubbles, crashes, and recoveries that defied every prediction made by the smartest people in the room. And I'll tell you what I told shareholders at our annual meeting in Omaha just this week. In 60 years of investing, I've only seen 5 years that were truly juicy with opportunity. 5. That means in the other 55, patience was worth more than urgency. Right now, in May 2026, people are in the most gambling mood I have ever witnessed in my lifetime. Select software reviews, and that should tell you everything you need to know. Stay with me, because I want to explain exactly why markets keep bouncing back, what's really behind it, and more importantly, why that bounce should make you more careful, not less. Let me start with what just happened, because it's worth understanding clearly before drawing any conclusions. The Strait of Hormuz handles roughly 20% of the world's oil supply. When it closed, people were right to be concerned. Every historical oil shock, every single one, has led to a major recession and a significant market correction. So why didn't it happen this time? Because the world is structurally different from every previous oil shock. 30 years ago, the United States was an energy prisoner, completely dependent on foreign oil. Today, America is the energy landlord. The U.S. went from energy prisoner to energy landlord over the past 3 decades through fracking, the lifting of the export ban, and the development of massive domestic production capacity. That means the U.S. actually benefits from the kind of oil disruption that would have crippled it in 1973 or 1978. Frazzly. So when supertankers diverted to the U.S. Gulf Coast, when Saudi Arabia activated its East-West pipeline, the market looked at the situation and made a judgment. This is a bounded event. The worst case isn't going to happen, and the market was right this time. But here's what I want you to understand clearly. The market being right about this particular event doesn't mean the market will always be right. And it doesn't mean the structural forces keeping it from falling will hold forever. Now, let me walk you through the 3 real reasons markets have been recovering so quickly from shocks over the past decade, because this isn't random. There are specific mechanisms at work, and understanding them is essential to understanding their limits. Reason 1, the Fed put. U.S. financial assets now exceed 5.4 times GDP, and the amount of household exposure to the stock market is higher today than it was during the dot-com bubble. Wall Street is Main Street. They are one and the same. If we ever had a genuine, sustained bear market, it would affect so many things beyond just stock portfolios that the Federal Reserve would face enormous pressure to intervene. That's the Fed put, the implicit guarantee that if things get bad enough, the Fed will lower rates, print money, and stabilize the system. I understand this mechanism completely. I've watched it operate for decades. But I'll tell you something most people miss. The Fed put has an Achilles heel. It's called inflation. If inflation is too high, they cannot lower rates or print money without risking hyperinflation. And it's the bond market, not the Fed, that actually sets the long-term interest rates affecting mortgages, business loans, and real economic activity. If the bond market loses confidence in the Fed's ability to control inflation, it simply stops buying Treasury notes, yields go up, and the Fed's rescue gets undone before it even begins. Fortune, that off switch is real. Keep watching it. Reason 2, passive investing. Passive investing now represents almost 60% of the market, more than active management. And that means every single paycheck, a portion of it flows automatically into the stock market, regardless of price, regardless of valuation, regardless of what the news says that day. A massive portion of the market is now price insensitive. They buy clockwork regardless of conditions. And that clockwork demand keeps the market from going down and staying down for too long. I understand this force too. And I'll tell you what concerns me about it. These passive flows largely come from 401k contributions from employed workers. If unemployment rises, if the job market weakens, those flows slow down or reverse. And the baby boomers are retiring in significant numbers right now. They will need to sell from their portfolios to fund their retirement. That retirement selling could eventually reverse the very flows that have been mechanically supporting this market for a decade. Fortune, reason 3, the new market participants. This is the one that most retail investors don't understand, and it may be the most important of all. There is a new layer of mechanical buyers in this market, trend-following funds, CTAs, managing over $350 billion, and options dealers hedging trillions in derivatives. Together, they create automatic dip buying. When volatility spikes, CTAs reduce positions. But once price stabilizes, their models detect a new uptrend, and they flip to systematic buying. The buying leads to more buying. That mechanical inflow helps create the V-shaped recovery that confuses and frustrates everyone watching from the outside. The rise of zero-day expiry options, daily options that reset every single day, has also changed how the market behaves. The gamma positioning that dealers manage now resets daily. The market gets a fresh chance to stabilize after any sell-off. The net effect is that corrections are violent but self-limiting. These 3 forces working together make it genuinely difficult to sustain a prolonged market decline. But here's what I need you to hear clearly. If this perspective is giving you a clearer picture of what's actually happening in markets right now, hit that like button and subscribe. I want to make sure this kind of real financial education reaches everyone who needs it. Now, let me tell you why none of this makes me want to go out and buy more stocks. Here is the part that most people completely miss when they see the market recover quickly from bad news. They see the recovery and think the market is resilient. Everything is fine. I should be fully invested. I see the recovery and think this market is expensive. People are not investing. They are gambling. At the Berkshire annual meeting in Omaha this May, I said something I want to repeat here clearly. We've never had people in a more gambling mood than now. The one-day options, the zero DTE instruments that now dominate daily market volume, that's not investing. It's not even speculating. It's gambling. Totally. Select software reviews. I've spent 60 years watching the difference between investing and gambling. The difference isn't the instrument. The difference is the thinking behind it. An investor asks, what is this business worth? What will it earn over 10 years? Am I paying a price that reflects its actual value? A gambler asks, where is this price going in the next 4 hours? Right now, in May 2026, the second question dominates this market, and prices for many assets will look very silly in retrospect. Select software reviews, the S&P 500 currently trades at 22 times forward earnings, well above the long-run historical average of 16 times. The last 2 times the index sustained a forward P/S above 22 were the dot-com bubble and the COVID pandemic. Both times it fell into a bear market. Vantage Circle, I am not predicting a crash. Right now, the current dip simply isn't big enough. What we have today is a slightly cheaper version of an expensive market. That is not the same as a distressed market, and I don't confuse the two. Four Corner Resources, Buffett's cash pile has reached record levels 3 times in the past 3 decades, and each episode preceded a major market collapse. In 1999, cash swelled just before the dot-com crash, where the NASDAQ fell 78%. In 2007, cash climbed alongside accelerated stock sales, and Buffett later deployed $80 billion into Goldman Sachs and General Electric at distressed prices. In Fido, I'm not saying history will repeat exactly. I'm saying I've seen this pattern 3 times before, and I respond the same way every time. Build the ark before the rain arrives. Let me give you something practical, because understanding what I'm doing matters far less than understanding what you should do. First, don't misread my cash position as a signal to sell everything. I never predict short-term market movements. What I am saying is this: predicting rain doesn't count. Building arks does. That is my Noah rule. I prepare before the storm, not during it. World metrics, and right now I'm building arks. Let me be direct about where Berkshire stands right now, because our actions say more than any commentary. Berkshire Hathaway holds $397.4 billion in cash and short-term treasury securities as of March 31, 2026. That is a new all-time record. The cash reserve now represents more than 30% of Berkshire's total assets, the highest proportion in at least 3 decades. The penny hoarder. People look at that number and ask me, "Warren, are you predicting a crash?" My answer is the same one I've always given. I do not attempt to time markets in the short term. My cash is sometimes built years before any crash arrived. I was early in 1999. I was early in 2007, but the eventual drawdowns validated the caution both times. My record is defined by avoiding permanent capital loss, not by predicting exact tops. Fortune, what I can tell you is this: in 2008, with the S&P 500 down 40% from its high, I deployed capital aggressively because prices reflected genuine fear and forced selling, not just recalibration. That is the environment where Berkshire makes its biggest moves. Four corner resources: the most likely time to buy is when nobody will answer their phones because the markets are collapsing. Fortune, right now, the current dip simply isn't big enough. What we have today is a slightly cheaper version of an expensive market. That is not the same as a distressed market, and I don't confuse the two. Four corner resources: Buffett's cash pile has reached record levels 3 times in the past 3 decades, and each episode preceded a major market collapse. In 1999, cash swelled just before the dot-com crash, where the NASDAQ fell 78%. In 2007, cash climbed alongside accelerated stock sales, and Buffett later deployed $80 billion into Goldman Sachs and General Electric at distressed prices. In Fido, I'm not saying history will repeat exactly. I'm saying I've seen this pattern 3 times before, and I respond the same way every time. Build the ark before the rain arrives. Let me give you something practical, because understanding what I'm doing matters far less than understanding what you should do. First, don't misread my cash position as a signal to sell everything, even if you're convinced the market is about to drop. Panic selling your entire portfolio is probably a bad idea. Timing the market is extremely tricky. If you sell today, you may miss out on tomorrow's gains. And even if you sell at the right time, you risk waiting too long to buy back in and missing out on the early stages of a market rebound. Fortune, I have never recommended that approach, not once in 60 years. What I do recommend, what I have always practiced, is this: maintain your long-term positions in businesses you genuinely understand and believe in. Hold them through volatility. Don't sell quality simply because the price went down. At the same time, build your liquidity, not because a crash is coming tomorrow, but because cash is not dead weight. Cash is optionality. It is the ark, and the ark only saves you if you built it before the flood. World metrics: separate price from value. The market is a voting machine. In the short term, it votes based on emotion, fear, and momentum. But it is a weighing machine in the long term. Value always wins, always. The only question is the time frame. When investing, pessimism is your friend. Euphoria is the enemy. The disarray in markets gives us the tailwind in our purchases. Bad news is an investor's best friend. It lets you buy a slice of America's future at a marked down price. World metrics: